Hello, it's Jonathan Wellham of Rocklink Investment Partners, and it's December the 8th, 2015. Now, today I want to talk about protecting and growing your capital. And before I get into just an overview of how we're approaching that, I want to just look at a couple of slides during the presentation. And the first one is going to lay out the performance of the TSX over the last 9, 8, and 6 years, both in Canadian dollar terms and also in US dollar terms, just to give you a little bit of perspective on where the Toronto stock market has been over the last number of years. And so if you look at that slide, we have three different performance periods, and then we do it those performance periods in two different currencies, the Canadian dollar and also the US dollar. I might also add, we're not including the reinvestment of dividends. We're just looking at the index. So interesting, if you go from 2007, the beginning of 2007, to today, the current situation, the Toronto stock market has not moved. It's down slightly. The same thing if you go from the beginning of 2008 right straight through to today. In Canadian dollar terms, you can see it's down 0.6%. So there's been virtually no movement in the overall index. If you go from 2010, when we started Rocklink Investment Partners, which is now almost 6 years, that was at sort of a low point in the market after it's bottomed out in March of 2009. The Toronto market's up about 17%, so there's a plus number there. Interestingly, if you go over to the second column, you can see how well the market has done or how poorly it's done vis-a-vis the US dollar. And so for US investors, the Toronto stock market over the last 9 years has not been pretty, because net, the US dollar has gone up a fair bit vis-a-vis the Canadian dollar, even though there's been some really wide swings over that period of time. And so that gives you a bit of perspective. Now, given all of the noise out there, last week it was the ECB, the European Central Bank, continuing to keep interest rates low, continuing to print euros. Next week, on the 16th of December, we're going to hear from the Federal Reserve. They're supposedly going to put interest rates up. People are saying, well, how do you manage through this? What are you doing? And as we like to tell investors, look, we're taking a 3 to 5 year perspective. And so on the next slide, it'll give you a sense of the basic strategy that we're utilizing, and trying not to be short term, but trying to buy high quality companies that can weather a lot of these crazy swings that we're seeing in the marketplace, which again don't surprise us, and we just have to anticipate and be prepared to work through them and take advantage of opportunities. So on this slide called Protecting and Growing Capital, you can see the 6 sort of points that I just want to highlight quickly for you. First of all, diversify. Diversification is a fundamental rule of successful investing. So we diversify across sectors. On another slide that I'll show in a few moments, I'll give you a sense of our current diversification as of November 30th. So diversification is important. Second, global businesses. The vast preponderance of the companies that we own do business in multiple jurisdictions, and they have exposure to multiple currencies. And this is a big positive if you have a weak dollar. And so we actually only have a couple of companies that are pure play Canadian businesses, and those are typically real estate companies. Third, prudent commodity exposure. We do not have a great deal of commodity exposure. You'll see in our sector allocation on the next slide that we have about 3% in oil and gas. We have another 5-6% in precious metals, and that's about the extent of it. So we've tried to minimize direct commodity exposure, because the commodity exposure means that you are going to be very vulnerable to global economic growth. And if you don't think that the overall economy is going to be rip-roaring, then you don't want to necessarily be exposed to a lot of commodities. Third, being very careful about leveraged businesses, or I should say in the fourth position there, being very careful about leveraged businesses. So companies with a really stretched balance sheet, lots of debt. We don't have companies like that. We have companies that are well positioned. They're very careful about their debt. They can weather the ups and downs. They can continue to pay their dividends even in a tough environment. And hopefully they can actually do acquisitions, and they can expand their business against their competitors in a tough environment also. Fifth, as we've spoken many times, we keep cash reserves and short-term bond reserves so that we dampen volatility in the portfolios, and we can also then have cash to go and buy stocks if they go down. So the stock market going down is not a bad thing if you have cash reserves. In fact, it's a good thing. And so we get excited when the market gets a little weaker, because then we can deploy capital at much better prices and give you much better overall returns over the long term. And then last, any bonds that we own are short-term and very high quality, so that if interest rates start going up, our bond values will not go down very much at all, and we can hold them to maturity and reinvest at higher rates. So we're very careful. So those are sort of 6 basic rules that we're following. And then on the last slide that I was going to show you today, this will give you a sense of our current diversification across 8 different sectors, because again, it's very important to buy good companies operating in a number of sectors so you don't get overly exposed to one area and maybe one problem that could occur in a particular sector. For example, if you had told me that the price of a barrel of oil would go from $100 to sub 40 today, and that OPEC would actually continue to feed the market, and so that we'd have a glut of oil, I would be quite surprised. And therefore, there's some events that are very hard to predict, and you have to be very careful that you don't get overly exposed to events that are difficult to predict. So, buying companies that have much more predictable business models is critical. So on this last slide, this different sectors that we have exposure to, you can see we have a large exposure to infrastructure. And these would be businesses, everything from pipelines to railroads to hydroelectric dams and facilities and so on, ports, airports, a whole host of different businesses that fall into infrastructure. We like those companies, very good dividend payers, hard asset backing. A number of financial companies or lending businesses. And we typically don't have a lot in banking or highly leveraged companies, but we do own TD Bank. We also have Customers Bancorp in the United States, but most of our financials would be very low leverage sort of investment management companies. Water and agriculture is a very indispensable area, and we have a large weighting there. Consumer staples and healthcare is another really wonderful area to be in. We've got big positions in companies like Nestle or Church & Dwight or Kraft Heinz, Coca-Cola, Johnson & Johnson. Again, great long-term franchises. Real estate would be 6%. Again, hard assets, real estate, good dividends. Precious metals, we maintain a 5 to 6% weight, and we continue to invest in the finance companies for the mining sector. So those are the royalty companies, the streaming companies. We've talked a lot about those. They are cheap, they are beaten down, and they are a great, wonderful hedge to monetary problems. If those ever occur, which we believe they will at some point, there's going to be some pressure with currencies and the whole debt issue that we've talked about for many years. These companies will do exceptionally well, and they are really cheap. Technology continues to be an important area in our portfolio. And then lastly, we maintain a small position in oil and gas, with about half of our weight in this sector alone being in Suncor, which we like. It's a very profitable company. A couple of other companies that we own across our portfolios would be Exxon and BP. And the similarity between Suncor, Exxon, and BP is that they are integrated oil companies. So they have refining businesses, big retail businesses also, and this gives them wonderful diversification within the oil industry itself, and they maintain a really quite good degree of profitability despite really low prices, and that's important for us. So they have staying power. So that's a quick overview in terms of what we're doing to grow and protect capital in a very, very volatile market. So early next year, we'll be sending out an update for you in terms of all the critical dates for taxation and all the different regulatory dates that it will interest you in terms of when taxes are due, RSP investments, and so on. And in the interim, we'll be sending out another quick update prior to Christmas and giving you some other information at that time. So if you have any questions, please don't hesitate to call, to stop by, or to email us at the office. Thank you very much for your support, and we'll talk to you soon. Bye now.